It's probably a buy the dip reaction. It's proven to be an effective tactic over so many times in the past, in the last several years, that I think investors are doing that. We will see less volume today.
But is that the wise move or not? Because we just had a market guest on who said we've been preconditioned to that, and that until that really gets worked out of our mindset, you're not really going to see the pain that's necessary.
We have been preconditioned, and the economic data today is, I think, different from the way it's been the last several years. I mean, growth is slowing. Revenue growth and earnings growth is decelerating. Growth of earnings in Q3 exceeded Q2, which exceeded Q1, something we wouldn't have expected at the beginning of the year. The trade situation, there's a lot of pressure on G20 and Buenos Aires at the end of the month. Probably won't come through. We've got the high yield leveraged loan, distressed debt, investment grade debt market under considerable pressure, levels and spreads at the highest level in more than 2 years.
Okay, so you just laid out a bear case. What are you doing about it?
What are you doing about it? I mean, our investors typically are global macro, many of them, and they look for the best opportunity where they can get alpha. So they will look for overreactions where there's emotion.
And you're saying there's an overreaction. This week is an overreaction.
I'm saying that they look for situations where there's an overreaction. I don't think today's environment is an overreaction. I think we are in a correction mode. You know, we've been that way, and I think that's going to continue for some time. I wouldn't be surprised.
Jim Cramer made a bold call, I think, just yesterday, and effectively said, you know, if in fact the Fed raises rates, you will have wanted to sell all of these stocks. You know, forgetting about buy on the dip, he would have said sell
yesterday morning.
Yeah, sell on the dip.
I don't know if he's still saying
well,
that.
I think that's the biggest concern for the market right now is the Fed looking at backward-looking data and tightening too aggressively, whereas the Fed the last 10 years has always been riding to the rescue of the market whenever there's been an issue and they've been, say, a first responder. It's more like the 1975 cover of the Daily News, Ford to Citi drop dead, Fed to bulls drop dead, because they're fearful that the Fed isn't, investors are fearful that the Fed isn't going to come to the rescue. And just the green futures this morning, over the last 10 weeks or so, we've seen multiple positive opens in the market that have gotten sold throughout the day.
Well, can I just say, I mean, we just don't know what the volume is like. I mean, this could be very thin, especially this morning, could be very thin, right?
Right. Thanksgiving week is supposed to be thin. And yesterday we saw above average volumes, but I wouldn't read too much into Wednesday futures.
What do you read into Larry Kudlow's comments yesterday? Political, market-based, where he effectively said, I don't see a recession. I don't know what you people are talking about. I read all this stuff. It's silly to me.
So, I mean, I think looking at U.S. economic data, we're seeing some signs of slowing. In the actual data we're looking at, you know, housing has certainly slowed. Auto sales have certainly leveled off here. You know, employment data has held up very strong so far, and hopefully that does hold up. But, I mean, we are seeing a slowdown from the torrid rate of growth we saw towards the end of last year. And just because things slow down doesn't mean you have to go into a recession. But at the same point, when things do start to slow, maybe the Fed should take a more wait-and-see approach, or at least tone down the hawkish talk, which they've been starting to do in the last week.
Our economic and financial indicators that we look at, you know, Mike Darter looks at MKM, doesn't give him an indication that we're approaching a recession anytime soon. But the Fed, Powell, on the 14th, he began a pivot, an important pivot, where he not only talked about the strength of the economy, but for one of the first times acknowledged some of the headwinds we've got. The trade situation, the global growth slowdown,
so he does what in December? What's the Christmas present?
Well, December's not the issue. December's baked in. It's
baked in.
What does he do next year? Do we have one in March and then pause? And if we do, then it's risk on again. Everything else constant. We still have the trade issue to get addressed, and we have earnings to get addressed. But it's really in 2019, first, second, third quarter. What does he do then? December's already done.
But are you looking for the commentary in December? Is that going to be the whatever is said in December? I imagine is going to be either the call in your stock or the present.
From now on, all 8 meetings in 19 plus December, we'll have summary of economic projections. We'll have a press conference as well as a statement. So the commentary is obviously important. Economic projections are important.
But is there anything the Fed could actually say in December that would make investors think, okay, we're free and clear, there's not going to be any rate hikes in 2019? They're going to say we're data dependent.
They're going to keep their options open, but they could, in that action paragraph, indicate that we see more of the headwinds, something he hasn't really done in previous statements, but which the BOE
But a
has
comment
done
from-
and the ECB has done.
But it's from like the October, in October when he said we're a long way from neutral, or
Right.
those kind of
Vice Chair
comments.
just walked that back last
Yeah, exactly. So we want to. You don't want to see comments like that, and if you see comments like that, it may not be a very fun Christmas.
Okay.
But will it necessarily be a very merry one if it doesn't say that? I mean, that's the absence of that. I'm
Well,
not sure the
it's
market will
just
care.
an overall tone of the speakers coming out. Our Fed Speak monitor has taken a more dovish tone
Right.
in the last 2 weeks, and so
Let me ask you one final question, because we were looking at retail sales yesterday. Obviously, we got a lot of the earnings reports. What fear do you have that what's happening in the market, the volatility in the market, if not the downward pressure on the market, is going to feed into the Christmas holiday season, meaning that people with stocks who felt really wealthy or were feeling at least pretty confident may not, when they get to the shopping mall, do as much shopping?
Business and consumer confidence can be negatively impacted by the prospect of a trade war that they think is imminent with China and stock market volatility. So we think
It can be. My question is, will it be?
Well, we'll know after the G20. We think the so-called professionals say you're going to have a 0.2 to 0.4 hit to the U.S. economy from a trade war, 1% to China. But that's the first round effect. Second round effect from confidence could be far greater than that. So it's a much more complicated, nuanced story than the empirical studies would suggest.
Mike?